Have you thought this through?
No way will that work.
Are you sure? Is there any money in that?
You'll never make any money doing that. How are you going to pay the mortgage? Just get a job.
You're going to try to sell that? Why can't you be normal like everybody else?
All right. Were your parents morons too?
The savvy entrepreneur to the rescue.
Congratulations. That really turned out well.
That's a really good job.
I'm going to admit it. I'm surprised.
You know, I wish I'd thought of that.
I never thought anyone would. How did you do that?
I'm so glad you're pursuing your dream.
I wish I had the courage to follow my dreams.
Welcome to the Savvy Entrepreneur Show. We're broadcasting here on WLCB 101.5 FM from the greater Chicago-Milwaukee area. If you are or want to be an entrepreneur, this show is for you. I'm Doris Nagel, your host for the next hour. I'm a serial entrepreneur myself, and I've counseled lots of startups and businesses over the past 30 years. I've seen a lot of mistakes. I've made plenty of them myself. The show has two goals: to share helpful information and resources, and to inspire, to hopefully make your journey as an entrepreneur just a little bit faster and easier, and maybe just a little bit more fun. To help with that, I have guests every week on the show who are willing to share their stories and advice. And this week, I'm lucky enough to have not one, but two guests on the show. With me by phone are Andy Walker and Chris Eckstrom, the co-founders and partners of Rock River Capital. Rock River Capital is a venture capital firm focused on early stage investments. For those of you who know the jingo, it's seed investments to B rounds. And they're investing in startups based in the Midwest with a focus especially on investing in Wisconsin. They're industry agnostic, but they look for disruptors in the industry. And we'll hear more about that, I'm sure, from both of them. Andy, one of the two co-founders, lives in Stoughton, Wisconsin, and prior to founding Rock River Capital, he was the CEO of Channel IQ, which was a leading provider of channel management solutions for e-commerce, which was later then acquired by MarketTrack. Previously, he helped build Fetch Rewards, a successful startup based in Wisconsin. He's also the co-founder of 426 Solutions, which was acquired by Computer Sciences Corporation, where after the acquisition, he became Vice President General Manager of Big Data. He also worked for the National Security Agency, something that he found very interesting but can't really talk about. For those of you who don't know, the NSA is the parallel agency of the CIA. It's the largest intelligence arm of the Department of Justice, and he says that he spent 5 of his 6 years there working overseas. He has an MBA from the Kellogg School of Business at Northwestern, a master's in engineering and systems engineering from the Stevens Institute of Technology, and a bachelor's in computer science from UW-Madison. Now, Chris, the other co-founder, lives in the Madison area after moving from Chicago, where he lived for many years. He previously ran the principal investment team of the Macquarie Bank in Chicago. And prior to that, he was a senior analyst at Black Diamond Capital Management, a hedge fund based in Lake Forest, Illinois, for those of you who don't know, is a northern suburb of Chicago. He's a graduate of the UW-Madison in both finance and economics, and is a board member of Big Brothers Big Sisters of Dane County. And he also says he has 3 small kids and now lives in the Madison area. So with that introduction, Chris and Andy, thanks so much for being on the show today. Welcome to the Savvy Entrepreneur Show.
Hey, thanks a lot for having us.
Appreciate it.
Yeah, thank you for joining us. I think the place to start that's natural is really to talk about Rock River Capital in general. So how and why did it get started? Why did you decide to do this?
Well, I'll start with this one, and Chris can kind of jump in. But when I graduated in computer science, there was really not a lot of opportunities in the state of Wisconsin. I was essentially forced to kind of leave the state for the career I wanted. And, you know, later on in life, I really wanted to figure out how to create those same opportunities in the Midwest. At the same time, a lot of really good things were happening in Wisconsin, things like Epic and Exact Science and all these great companies. were starting to take off, and there was now a market for these technology companies that didn't exist before. And it just felt like, a timing was in our favor. So Chris had recently, moved back to the Midwest, and he moved back to Wisconsin. So I called him up and said, hey, I'm really thinking about doing this venture capital fund. I need an institutional investor like yourself. Would you be interested at all? And Chris was interested, so I'll let him take it from here.
Yeah, I think the other thing too, when I moved back and I spent the first year, I was on the road quite a bit working for big investment banks and hedge funds, and saw a real solid opportunity in Madison, in Wisconsin, then to put money to work in the VC space, specifically looking kind of to do that second round of capital, put $1 million in startup companies. There really wasn't anybody doing that, and I saw Andy's background as a huge plus and a huge advantage for a venture capital fund, and also help create companies and get them off the ground and get them up and running.
Yeah, it's really kind of shocking how little capital, at least in the past, has flowed into the Midwest. One of my guests was sharing with me what a huge percentage of capital actually goes to Silicon Valley and Boston and a few other places, and really a shockingly small amount to other places in the country, right?
Yeah, I mean, I think, 50% or something massive goes to Silicon Valley by itself. So even if you ignored every other city and you just looked at Silicon Valley by itself, I mean, by far, the most capital goes there. But I mean, if you look at it, most of the venture capital funds are in Silicon Valley. They're investing in their own backyard. And that's what we're trying to do as well. I think that there's some great shining lights. I mean, we all know the statistics on the amount of capital that gets invested in those big cities you already brought up. But, look at something like Drive Capital in Ohio. I think they're just one of the best examples of good things going on in the Midwest. These are two ex-Sequoia partners from Silicon Valley that said, hey, there's opportunity in the Midwest. The next great companies are going to be born here, if you believe in kind of the Steve Case's third wave concept. And, that's one of the most successful funds in the country right now. I mean, they're just phenomenal. So you can do this in the Midwest. I think it just takes a different approach. I think you need to bring that Silicon Valley approach to the Midwest in some cases. And I think that's what Drive Capital's done. And on a much smaller scale, that's what Chris and I are trying to do. I
think when we looked at Wisconsin, I mean, there's, Andy mentioned there's Epic, Exact Sciences, but there's also a great foundation of entrepreneurs. If you think of some of the companies like Menards and SC Johnson, and, those companies were started by entrepreneurs, and Wisconsin's got a great entrepreneur culture. And we saw, the UW Madison system, or UW system, UW Madison, Marquette, Wharf. There's various things that generate a lot of intellectual capital and ideas, and that also attract talent. We just sort of saw that as an advantage for the fund that can help us be successful, create companies, help drive successful companies and exits.
Well, I want to circle back to the personal side of the story of Rock River Capitals. I'm curious, how did the two of you even meet? I mean, Andy, you were in Stoughton and Chris was in Chicago. How did your paths ever even cross to begin with?
Yeah, we actually met each other in college. So Chris was a senior when I was a freshman. We've known each other for decades at this point. We had very different kind of interests and backgrounds in college. Chris was more of the finance guy. He was in the business school. I didn't really know what I wanted to major in, to be honest. And later I got into computer science and I ended up graduating in computer science, and we went different paths, with our careers, but we always stayed in touch. I always had a great respect for what Chris did, and it was always fascinating to get together with him and learn about, his life in a hedge fund. And anyways, we always just kept in touch. We'd get together, every year or two and chat. And then our careers both kind of led us back to Wisconsin, and when we got back here, both by choice, we could have stayed, in Chicago, and I could have stayed on the East Coast, but we wanted to come back. And when we came back, again, we kind of reconnected and said, what do we want to do now? So we've had a great friendship for a long time, and I got a ton of respect, for his background.
Yeah, likewise. Yeah, it just made sense. And we got together and we said, hey, what can we do? What can we build? And I've always been run opportunistic hedge funds and special situations hedge funds. And like I said, it just seemed like the time was ripe, right? And the opportunity is ripe to start a venture capital fund in Madison, raise some capital and also, build the ecosystem. It's now that we're we're both in Madison. It's a relatively, small, and I think it's a great sized town, but, it could definitely use guys like us with our connections from outside the state to help build the ecosystem and create something great.
I think the other thing that was part of this is just the stage of life that Chris and I were at too. I mean, we both were lucky enough to have a couple of wins, and when you can't just decide you want to do a venture capital fund one day, you got to put some skin in the game. So, Chris and I have over $500,000 each into this thing. So we needed to show our investors how much we believed in this. And the only way to do that was to put significant skin in the game. And the only way to do that was to have had some wins prior to this. So there was also a timing, both of us were at a stage of life. We both wanted to do this. The things just aligned. Well,
you've just segued perfectly into my next question, which was really about getting started. I mean, there's probably lots of people who think, wouldn't it be great to run a venture capital fund? But, kind of the gap between the idea and actually putting one together is probably a bigger gap than most people think. Talk about some of the challenges and things that you were prepared for and things you weren't prepared for. Chris, why don't you start?
Well, I guess, I was lucky enough, I'd worked for Macquarie and Black Diamond, two institutional investors. I'd been part of the fundraising effort and had sort of done this before and had an idea of the process. So I think, that helped a lot as well. I think one of the big challenges we both had is, I was sort of in Chicago and Andy was in Chicago and DC, and we really didn't have a ton of connections to the Madison and Milwaukee and southern Wisconsin area. So it was probably, the biggest challenge was sort of trying to network and find the people who could be limited partners in our fund.
And how did you find additional investors, and how do you find additional investors to the fund? Because obviously $1 million between the two of you is a great starting point, but you need to leverage that, right? So how did you go about doing that? Andy, why don't you?
Yeah, I mean, really the idea was let's start with an anchor, right? We need a couple of anchors and we can build around that. So we really need to go out and find some of the larger investors first. That was our strategy. So the largest of those investors was, the Badger Fund of Funds, the state of Wisconsin program. So, we went and met with Ken Johnson and we kind of pitched our case on what we want to do, and he believed in us personally and the investment thesis. And he was our first anchor. And from there, we went around to a couple of other large institutional investors and then, went to kind of high net worth and family office. So we kind of started with the anchor investors and worked our way out. And I think we also really just had to learn a lot about the marketplace as well. One of the things we learned early on, I think it was one of our very first meetings actually, and on the limited partner we were talking to said, if I gave you all this money today, tell me the first 3 companies you would invest in. Oh. And I didn't have a really good answer for him. And he said, well, tell me about what are the best 3 companies right now in Wisconsin that you would invest in? And I listed off a bunch of good companies but I didn't really have a good answer. So then Chris and I went back and we said, you know what? We can't spend all of our time fundraising. Even though we don't have any money, we have to go spend a significant amount of our time with the companies out there that are raising capital so that when we go talk to these LPs, we can give them very specific examples of companies right now that we like, that we would put money to work in. So right. when we had that first horrible meeting, we essentially we changed how we spent our time. We started spending half our time with entrepreneurs and young companies and figuring out what the challenges were, what was going well, what companies did we like, what companies did we not, love from an investment standpoint. And that really helped us in our fundraising process. We had very specific examples. We could talk about tangible companies. And I really think that resonated well with the people we were talking to.
Interesting. Well, it's funny because you hear stories on the reverse side, right, of people, entrepreneurs who are pitching to folks just like you. And the stories are legion out there of investors. They try to get a call, they try to set up a meeting with you, and then they get you actually on the phone and they think that they're going to set up a time later. And, a lot of times, investors like you are just like, hey, I got a couple minutes right now. Sell me on investing in your company. They don't know what to say, right? So it's pretty funny to hear it on the flip side that can happen too.
We can definitely relate. I mean, I think we ended up having 300 plus meetings with potential investors in our fund. I think we ended up getting about 50 of them. So, it was a, 1 in 7, 1 in 8 hit rate. It's definitely tough. And if you think of, we're raising money for a fund, sort of an idea, a thesis we have, not necessarily a specific product. So, I thought it was quite daunting, and it was, something I'm really proud of. We ended up raising $26.475 million from, like I said, I think there was 49 or 50, different entities. And that was a challenge. There was some times where we thought it would be, I don't know, didn't know if we could get it done. And at the end of the day, we persisted and, showed grit. And I think that's, similar to the companies that are raising capital. They need to have the same persistence and grit and sort of not take no for an answer and just believe in yourself and that you can get things done and make things happen.
Yeah, I suspect that most entrepreneurs pitching to investors like you probably have no idea of how much empathy there really is, because it's, it's a circular process. All right. So tell me about some of the kinds of companies that you're looking for. So as part of the process, you really honed what you were looking for and how you were pitching to your own investors. What kind of companies are you looking for? Who's a good fit for Rock River Capital?
Yeah, I'll take this one. So, at the end of the day, we're looking for companies that have a growth rate that makes sense for venture capital. So this is a really hard concept, I think, for a lot of people to wrap their heads around, but venture capital is one of the riskiest forms of investment, right? So, you need a return to justify that risk. So we tell this to our, when we meet with entrepreneurs all the time, we say, look, our investors are expecting us, to return, 3 to 5 times this fund. We need 10x a return on our investments in each company. So when we look at your software company, what we're looking at is, will this thing, when we put in $1 million, will we get 10 million out, right? That's the mentality we have to go in. And we understand that not every one of our companies is going to work. We're going to have, a significantly high failure rate in the venture capital space. So because of that, the companies that do win have to win big. So when we look at your company and you show us that there's a 10% return for us and you're going to double the size of the company, that's not big enough, and this is a really hard concept to get past, because I don't want to discourage people from going to create those companies. Those are great companies. Those are lifestyle businesses that can do really well and can make the entrepreneur extremely happy. But what they won't do is they won't make our investors happy. They won't make our fund. And unfortunately, we can't invest in those. So the number one thing that we are investing in is high growth. And the only way to get high growth is large markets. So the best advice I think I was given was from Drive Capital, actually. And they asked me, they said, what is the one thing you can't change when you look at a company? When you're looking at companies, what's the one thing that you have to have out of the gate that you can't change? And, I think my response was, well, the entrepreneur, it's got to be a great entrepreneur. They said, no, that's not true. You can go get a new CEO. You can go change the personnel in the company. And I said, okay, well, then it's got to be a great product. It's got to be, the product's just got to wow me, and it's got to be great. I said, well, that's not true either. You can go fix the product. You can go hire, new developers, or you can go essentially go pivot the company and change the product. I said, well, great. If it's not those two, then what is it? And they said, it's the market size. If they are not going after $1 billion market size, you're never going to get the return you need for your investors. You have to enter a large market. So if I see an entrepreneur that's showing me a product that has a total addressable market of 50 million, we're out. It's too small. If it's 100 million, we're probably out. It's too small. So I have to be shooting for big markets that we can do disruptive things in large markets. Disruptive things in small markets will not work for us.
It's funny you say that, because when you're an entrepreneur first starting out and you're just looking for a few sales. I mean, an addressable market of 50 million just sounds so huge that, you know.
I know. It's counterintuitive. It's really hard for us to have this conversation.
But that could be a great business. That could be a great business for, Andy mentioned a lifestyle business, but, a $50 million market opportunity. That's great for somebody who starts a business that has $1 to $2, $3, $4, $5 million in revenue. That's, that generates great income for an entrepreneur. It makes it tough to invest in it from a venture capital standpoint, from a venture capital fund.
All right. So I have to ask though, when you say an addressable market, I mean, here's something that it seems to me there's maybe some misconceptions or at least a lot of wiggle room. So, I've talked to entrepreneurs who have this enormous idea of what the marketplace potentially is, number one. And query, is that really,
Yep.
Are they really right about that? I mean, you could say, potentially the market for Kleenex is huge, but really what part of the market are you going to be able to get to? And second, you got to have some way of breaking into some of these markets. Either it's changing an existing fairly mature market, or it's a brand new market where people don't even know there's a need yet. So talk about how you figure out what the market really is.
Well, I think the best example I can give was, when I was at Channel IQ. So I was pitching a group of investors, Channel IQ. I was trying to raise money for that business. And I did not found that company. I was a new CEO that came into that company. They'd already raised maybe $20 million prior to me getting there. And I was struggling to figure out our market size. So prior to going in and meeting with this group of investors, I had done this kind of top-down approach. Look, there's trillions of dollars going into e-commerce. It's growing, e-commerce is growing by, 10, 20% year over year. It's going to be massive. And the investor looked at me and said, well, what's your average deal size? And I said, well, our average deal size is $32,000 a year. He goes, great. So how many people are out there for you to sell $32,000 a year on average to? And I said, well, I started counting and, kind of said, I think there's about 100 of these. And then he goes, okay, so I just did the math. He goes, your market size, according to your math, is only about 75 million. And I said, oh, so that's but that was a great meeting, because what that taught me was that your total addressable market's really simple. Figure out your average deal size and figure out how many people you can sell it to and multiply the two together. So that's the easiest way to come up with your total addressable market. What you talked about before was how do you get those first deals and how do you start selling into that market, right? So once you figure out, kind of how many people there are to sell to, you got to figure out a way to segment them and figure out where you're going to start, right? So in an ideal world, you segment, let's just take Channel IQ as an example. If you look at that business, we had a couple of clients that spent $1 million a year with us. We had a couple of clients that spent $12,000 a year with us. And there's a bunch in the middle, and the average came out to $32,000. So it follows common sense. Well, the easiest way for me to ideally break in this market is go get some $1 million deals, right? Like that's going to be the fastest way for me to kind of grow here. So, and the answer is kind of somewhere in the middle, right? It's going to be hard to walk into some of these $1 million deals right out of the gate without any sort of track record. But you also don't want to start with the $12,000 deals because you're going to be herding cats. So, what we did there was kind of start with those $50,000 to $100,000 deals. You close a few of those, then you work your way up market. And then the only way you want those $12,000 deals is when you've automated your product to a point where you can make it self-service. And then you start selling down market. So first, figure out what your market is. Second, figure out how to segment that market. And third, figure out what segments you're going to address first and go there. So it's the difference between total market, or it's the difference between a market, total addressable market, and service addressable market.
And that's sort of like when we look at our investment philosophy and what Rock River's trying to do, we typically look for companies who have, raised a little bit of capital and then have 2 to 3 referenceable customers, have 2 or 3 of those $30,000 a year SaaS deals. And then we, invest typically $1 million, and we're trying to get that company from 2 to 3 customers to 10, 15, 20 customers, and help them, with that sales process and sales cycle that Andy sort of went through. His expertise at Channel IQ and at Fetch and at 426 Solutions, really is valuable to those entrepreneurs in helping that process, accelerate that process.
Well, now you mentioned, at least your website says that you're looking for companies that can disrupt. How do you determine what a company is that's disruptive? I mean, how do you assess that factor? Because everybody will say, I'm disruptive. This is cool. This is neat. Yeah. This is new. Talk about that a little bit.
Yeah, I mean, that is the challenge, and that's what creates unicorns. We're just looking for companies that have a different twist or a different angle that, will disrupt, is the better Kleenex, is the better mousetrap, is something that, we can scale. And that goes back to Andy's point about scaling quickly. Disruptive ideas will scale quickly and grow fast. It's sort of looking like that.
Well, I mean, I think when we look at companies, first and foremost, we're trying to figure out, is the idea novel? If you're just making a slightly better widget, in most cases, we don't find that disruptive, and we don't think that has the growth potential that we're looking for. So first step is this novel? Are you truly solving an existing problem in a totally novel way, or are you solving a new problem that nobody's ever solved? It's got to be something really novel and really, unique in some cases. If it's just a slightly better widget, it's really hard to make an investment there.
And a lot of times we'll chat with the first 2 to 3 customers and actually ask the customers that question. How novel is this? What have you seen in the competitive landscape? Why did you decide to buy this software product or service? What is it about it? And that's sort of insightful as well.
I'll bet it is. I need to interrupt you and ask you to hold your thoughts for just a second. We're going to take a quick break for station identification and a word from a couple of our sponsors. But stay tuned, folks. We'll be right back with the co-founders of Rock River Capital. This is Doris Nagel, and you're listening to the Savvy Entrepreneur Show. With us this week are our guests from Rock River Capital Partners, and we've been talking about some of the kinds of companies that they look for when they're funding companies. Talk a little bit about the process of actually going through and doing due diligence and evaluating companies that are potential prospects.
Well, I mean, it's essentially kind of a funnel process, the same way that, some of our companies would look at their sales pipeline as a funnel, right? You get leads, those leads are then qualified. You take a qualified lead and do some sort of demo, then it goes into. So anyways, that's a typical sales pipeline. I think we have a similar pipeline, right? We find leads in companies. Either we find them or they find us. Then we have to qualify that lead. And a lot of times that is by looking through some sort of pitch deck, but there's some sort of printed material usually that we start with. Then if what we see in that material looks interesting, then the next step is usually a phone call. From that phone call, we try to assess, just some basics, some fundamentals of the company. From that phone call, then it would lead to an in-person discussion. And then, ideally the goal is to get to a term sheet. Once we have a term sheet, then we start the diligence process, which is really trying to flesh out all of our assumptions, right? We assume that we can sell this for this much money. Let's get on the phone with 3 or 4 customers and see what they say about that. We assume that it's going to take $500K to build some of these features that we think are necessary. Let's go look at the software and figure out if we think 500,000 is a reasonable number to build that. So it's things like that. Once we have the term sheet, we're flushing out assumptions.
We've probably looked at over 800 to 900 companies in Wisconsin and around the Midwest. And typically, wow, we like to track companies. So we'll do the early stage, like maybe an initial discussion and look at their information. And then if we like it right away, we'll write a term sheet and do more work. But a lot of times we just like to watch and see, they might be a little too early for us. They might not have enough customers or revenues, or they might need to build a product, some sort of feature and a product. So we do like to track them and get their quarterly or monthly updates. And that really helps us kind of see how, kind of handicap how they can execute on their strategy and how they're doing.
So have there been companies, or do you see there probably are likely going to be companies who came to you, pitched to you, you said, you need X and Y and Z, then come talk to us? Do you think that there are some that then would be great prospects?
Yeah, I mean, the last investment we just did was exactly that. Jason Weaver, who's a great entrepreneur. He's done, he's had several exits. He's a smart guy. He met with me about a year and a half ago in a coffee shop about a company that he wanted to build called AirDeck. But at that point, it wasn't even a company. He had kind of this PowerPoint slide, and he had this idea, and he goes, you know what? I'm having a really hard time pitching. The whole idea came from him trying to pitch investors. He goes, I'm having a hard time pitching investors because they want to see my deck, but my deck requires audio over it. I have to explain some of these slides and get my sales pitch out there, but I can't do that if I just email them a deck. So I want to build this platform called AirDeck that allows me to put audio and video over documents like a PowerPoint slide. So I said, well, that's really interesting, but, your PowerPoint's pretty strong, and Adobe's got PDF, and there's all these things out there, these headwinds that you're going to have to compete against. I'm just not sure. I would go try to get a couple of customers and use them as a reference to, help figure out if there's a market for this and what features are needed. So this was like a year and a half, 2 years ago. And then he gets his company going and COVID hits, right? Where all of a sudden the entire world goes virtual. And this product that was interesting before is all of a sudden super interesting.
Right.
So we immediately get on the phone with Jason. We're like, Jason, we think this is going to be awesome. Let's go do a big round. And at that point, he had already gotten 10, 20, 50 customers, and he was really starting to figure out what features needed and what customers were using it for. And it was just perfect timing. But that's a great example of somebody we met with 2 years ago. I didn't really see it then, and it progressed over time, and it was just the right time.
I mean, that goes back to our learnings from fundraising as well. When we were out, we were fundraising, but we were also meeting with companies. And when we meet with those companies, even if we couldn't invest, we gave them advice. We sort of, tried to be valuable resources. And I think another one of the deals we did in June was a company called Smart Care in Eau Claire. And it's a company that we met with, a year and a half before we invested in. And the founder was really struggling on how to create, website hits and a sales funnel. And we led him down, working on his search engine optimization and blogging and getting free Google search referrals. And, we ended up investing because he came back to us and he said, hey, I like what you guys did. It was working. I'd really like to have you guys involved with the company. So it was a deal, potentially we wouldn't have gotten if we hadn't volunteered our time and helped the entrepreneurs grow at the early stage.
Before we started recording, you, Andy, were talking about the importance of a management team. And that's a theme that I think other guests have talked about. Talk about what you're looking for in a management team.
Yeah, I mean, all startups, I've said this 100 times, I'll say it again, but they all come down to two things. Can you build it and can you sell it? So we really like to see from a management team, ideally three legs of the stool. It's kind of the CEO, the CTO, and the head of sales, the CRO or VP of finance. And those three people, that's kind of the optimal scenario, but that almost never happens. Usually the companies that we see have one or two of those. And we're really trying to find teams that can build what the market needs and can sell it. And those are two different motions sometimes, but that's what we're looking for.
So how do you help companies and work with them who maybe don't have all three of the legs on the stool? I mean, I'm envisioning that could be kind of a delicate process sometimes because maybe there's a great CEO, but his brother-in-law or his best buddy is the chief technical officer and just maybe isn't cutting it. How do you deal with some of those challenges?
Very delicately.
Yeah. There's times where, we're pretty blunt and I'm sure we have offended people. And, there's times where we just kind of flat out say, look, you're not doing a good job selling this. You need to find somebody who can. Or, there are times where we said, hey, we really like the product, that we really like the company, but we're just not sure that, you're the right person to run it. And, those are hard conversations to have, but it doesn't mean we won't have them.
And sometimes most of the deals too have board of directors too, so we can, influence the board and kind of talk with, if it's us or other board members and sort of form a consensus view that maybe the CEO or CTO needs to be replaced.
But I think in most cases, what we see is, hey, you're doing a great job. Why don't you focus on product, and let's go hire somebody to do the sales side. You're doing a great job building, but you're just not doing a great job selling. So in most cases, we're augmenting a staff team, a management team. We're not replacing. It's pretty rare that we're replacing at this early stage. So things that we do to help is, we do help recruit via our network. We're always looking for talented people that we can place into companies. We have recruiting, agencies that we work with regularly, and we're happy to connect our portfolio companies to them. We also just have no problem diving in ourselves and saying, hey, let's look at this sales process together and see if we can help. Let's look at this software development process together and see if we can help. So, we'll do whatever it takes. I mean, in most cases, we're just trying to do the right thing and make the team better.
Yeah. Talk about some of the other companies that are in your portfolio.
Sure. Yeah, one of the other ones that's doing well is called SIFT Medical. SIFT helps healthcare systems track reimbursements. The company signed a big customer last year and now is working with some of the largest healthcare systems in the U.S. to improve their working capital cycles, and it's doing really well. And that was a company initially. I think Andy served on the board before we had closed the fund. He was a board member for a smaller venture capital fund, and we really got to know that team. And we just after we closed the fund, we invested.
Any other companies in the portfolio? I mean, what do they have in common that looking back you can see?
So we did the final close about 2 years ago. We've invested in 8 companies. We're working on deal number 9 now. I'd say they all have some of the things we've touched on before. They all are fast growing. They all have potential to have, big growth, big revenues in big total addressable markets. I think all the entrepreneurs are great. We've been really impressed and excited to work with the entrepreneurs. I mean, they're all software. They all happen to be based in Wisconsin as well.
I mean, I think they're also all solving real world problems. One of the things that, I love is, in general, we don't look for technology that needs a problem to solve. We look for somebody that recognized a problem in an industry and created a solution to solve that. Those usually sell much better than, hey, I've got the best widget in town. Let's figure out what to do with it. So almost all of these companies are solving great problems, and it makes it really exciting.
You said you've looked at probably 800 companies. That's a lot of companies. And I'm sure you've seen some pretty common mistakes with companies that pitch to you. Talk about some of the most common mistakes and advice you might have for companies looking to pitch to maybe you, but really to any kind of investor.
Yeah. So, I mean, we both got our list of things. I would say first and foremost, start with the problem that you're solving and why this problem needs to be solved. I think a lot of times people start with maybe their background, their resume, which is great. That's useful. I want to know that, but that's not the best starting point. So start with why are we here? What's the problem we're solving? The other big challenge that I see, like I said before, is I see people focusing on niche markets, and, niche markets might be a nice beachhead to start in, but you got to show us why this is going to scale. Why is this a big market? Why is this company going to grow? A very specific niche market is not going to really get investor too excited. I would say the last thing that I see that's pretty common is setting, valuations on things when it's way too early to do so. So I think too often we see people come into our office and say, this is going to be huge. We're raising $1 million round on a $20 million pre-money valuation, and, we think you should get in. And what I say is, look, even if I love your idea, before we go any further, even if I love your idea, even if I want to invest, if I put that amount of money in at that valuation, the amount of equity I'm getting in your company is going to make it insanely difficult for me to get a return. So it just steers the entire conversation in the wrong direction. So what I would say, my advice would be, sell the investor on the problem, then sell them on why you're the right people to solve that problem. And don't even really discuss valuation too much. Let that come out in the term sheet. Let that come out when you get there.
Yeah, I think that's a great list. I'd add to that too that, when we meet with founders, confidence is great, but sometimes arrogance is bad. And we when we meet with founders, it's really a relationship. If there's not a personality fit between us and them, it makes it tough. These are companies we're going to want to have weekly or monthly or quarterly conversations for the next, 3 to 5 years. So I think coming in and being confident but not cocky is also key.
It's a really hard balance, isn't it? Because a lot of entrepreneurs are so excited and, the idea and the company is them. And it's very hard for them not to take a lot of stuff personally. Have you seen that too?
Yeah, many times.
Yeah.
Yeah. I mean, it's, we want to give constructive feedback. I mean, we have the advantage of seeing 800 companies this year, right? So our pattern recognition looks a little different. So we like to give constructive feedback. Hey, we like what you're doing here, but I would explain your addressable market more. Or, hey, we don't think that that's the right beachhead and here's why, whatever it is, right? And it's really hard sometimes to give that feedback and not upset somebody who's spent they've really dedicated their entire life to this thing. So it's a real balance. We do our best with it, but I'm sure we've made mistakes.
Yes. I mean, some VC funds will just, write a check or make an investment and sort of walk away. That's not really our mantra. We really like to invest and be mentors to entrepreneurs, advisors, friends, the people that they call when they have a problem that keeps them up in the middle of the night. That's our value add, and that's how we think we can help. And, we just have opinions, but like Andy mentioned, I mean, we've both done this for a while now, and your pattern recognition becomes really, really good, and you become attuned to things that you see happening over and over again, and you get frustrated when an entrepreneur just doesn't believe you or digs their heels in the sand and thinks they're right. It's just so there's like I said, there's tons of opportunities we've seen, and so it's it's a quick pass if you just don't have that fit, the personality fit. It's kind of one of the reasons to pass.
Yeah. Well, it's interesting. You're very good at segueing into my next questions, because I was going to ask you both what you enjoy most about working in venture capital and having your own venture capital fund. And I think, Chris, you started to allude to it, which is really, it sounds like you love being part of the story. Is that fair?
Yeah, I mean, yeah, for sure. I mean, it goes back. I mean, that's what I'm in Big Brothers and Big Sisters of Dane County. It's mentoring. It's helping. It's working with entrepreneurs to create great companies, being exposed to new ideas and collaborating and all of that sort of stuff. That's good things. That gets me excited. Helping build an ecosystem, being, on the ground floor of a startup company that could turn into Epic or Exact Sciences, is really, exciting for me.
I kind of geek out over the business cases themselves, right? Being in venture capital, we get inundated with different business models from everything you can imagine, right? And I just love seeing all the ways that you can make money out there. This kind of been a long-standing, thing for me. I have a ton of respect for entrepreneurs in every walk of life that have figured out a way to make money. I mean, I'll give you an example. My wife's grandfather started this manufacturing company 65 years ago, and they basically make aerosol cans. He built this amazing company, but I'm just sitting there going, you built this great company and you make cans? And then I get to go to work and I see these amazing software companies, and some of them are selling a piece of software into healthcare. And then the next guy is selling a piece of software that he gets paid 1 penny per click online and he needs millions of clicks. It's so fun to see all of these different models and to think through the math and to talk with the entrepreneur about how to scale it. And for me, that's just by far the most exciting, is to really just geek out on every possible business model you can see.
It's interesting. I'm guessing that both of you have really seen the ecosystem grow, because you've looked at 800 companies. I have no idea how many more you probably chatted up with at various networking events. And of course, people come to you because you have money, and that's a hot commodity when you're an entrepreneur. How have you seen the ecosystem grow and change in Wisconsin and the Midwest since you started?
Yeah, definitely. More excitement. I think I was in Chicago kind of early days, and there wasn't, I was in finance and hedge fund, but there really wasn't much talk about startups, and sort of as, from 2008 to 2015, it just became the rage in Chicago. And it is exciting to see, from the Groupon exit or Clever Safe. I mean, there's been some great companies that really created a lot of buzz. and created a bunch of VC funds in Chicago. We've sort of seen that in Wisconsin as well. There's been more and more venture capital funds start up and be successful. There's been, exits. I think Exact Sciences in Madison, the guys created a multi-billion-dollar company that got people excited. It wasn't a VC investment, but it was, a penny stock that, just took off. And then the corporations, the big Fortune 500 or 1,000 companies in Wisconsin have created venture capital groups.
All right. Yep.
The UW system, Marquette, some of the other universities have started entrepreneurial programs and accelerators and, incubators. Not to mention, the generator in Madison and Milwaukee, they've created an amazing ecosystem and just exploded their programs, throughout Wisconsin and throughout the Midwest.
Yeah.
So just, it's how we're going to drive the economies in the Midwest from, industrial manufacturing to technology to software and, drive the economies and create companies and vibrant communities.
Chris touched on a lot of them. I think, Joe and Troy, what they've done with Generator, they put a great spotlight on, company creation. I think that's where we need more of that. We need more company creation, and we've got to get people thinking about, large companies, not just niche companies and specific. And, how do we get large VC backed companies? And then, the next thing we're really trying to do is get those big exits. I think that's the next step. We need $1 billion exits like Chicago's had, like, Silicon Valley. We need some $1 billion exits. As much as I like Epic and Exact Science, those aren't exits, right? Those were not VC backed. Those companies will really never be sold. One's already public and one probably will never be sold. So we need to create some $1 billion companies. And what that'll do is create a bunch of millionaires to go around and start new companies. And it's a flywheel effect.
You need the next Google, right? The next Microsoft, the next Dell, something like that.
I mean, that'd be great, but we don't even need, those are multi-billion-dollar companies. They call them unicorns for a reason. When you get to that $1 billion benchmark, you're a unicorn, right? And, Chris mentioned CleverSafe in Chicago. I think it's a good example because it was not a $100 billion exit. It was $1 billion, right? It was a great exit. And I don't know the exact number, so I might be off, but it was, it was a unicorn and it went really well. More of those would be great. We don't necessarily need to create Apple or Microsoft, but creating the next Root insurance company. Drive Capital just went public with that for a ton. I'm trying to think of some of the other unicorns we've had in the Midwest. Exact Target in Indianapolis, right? Sold to
Groupon, maybe, I don't know.
Yeah, Groupon was, I think when they went public, it was like $6 billion or so. But I guess Exact Target's probably the best example of what an exit can do to a city. That's in Indianapolis. He sold it for $3.5 billion. Scott Dorsey is not only one of the smartest people I've ever met, but also one of the most humble and just amazing people. He started this great company, sold it to Salesforce. What did Salesforce do? They set up their second United States headquarters in Indianapolis because of this acquisition. The entire ecosystem took off after that.
Yeah.
Those exits can have a huge impact.
It's also for the entrepreneurs, one of the most successful companies are usually generated from repeat entrepreneurs. If somebody has, Mark Cuban has his broadcast a smaller sale and then creates broadcast.com, you have that $15 million exit. The next one's a $500 million exit. And then you have the $1 billion exits. It's those repeat entrepreneurs, getting them exits, getting them capital. As Andy mentioned, you create a bunch of millionaires. They're willing to leave their safe, corporate jobs to go try to start unicorns, try to start whatever their passion is, start a software company or build a widget or build a better mousetrap or, whatever it is. It just gives people freedom.
Yeah, or helping investors to venture capital firms like Rock River Capital, right?
Mm-hmm. Yep.
So what do you think Rock River will look like in 3 to 5 years if you're successful?
Well, in 3 to 5 years, hopefully we're on fund number 2. So we'd like fund number 1 to be, we'll probably still be following the existing portfolio companies in fund number 1 with follow-on investment. But in general, we would be on fund number 2. I'd like to see fund number 2 with a similar investment thesis, but a larger fund and a larger geography. So, we have kind of a $25-ish million fund right now. We're focused very much in Wisconsin. And we're focused very much in that seed stage, which is, call it 500K to 1.5 million on the first round. So I'd like to see the next fund be, kind of 50 million in size. I'd like to see it keep a similar investment thesis, but be able to grow the portfolio companies and maybe do some larger rounds as well, and change our geography, not just be Wisconsin, but start looking more in Minneapolis and Chicago. And we already do a lot to partner with funds outside of Wisconsin. The last investment we did, we had a fund from, we had Rise of the Rest and we had Cultivation Capital, and we partner with other investment funds all the time. I would like to be able to enter their geographies and partner with them, not just invite them into my geography.
Chris, anything to add to that?
No, I think that was great.
One last question. We're almost out of time. If a company is interested in seeing if Rock River Capital is a good fit for their needs, or they think they might be a good fit for you, what's the best way for them to start the process and reach out to you?
Check out our website, rockrivercapital.com. There's a link to send us an email. Also check in our profiles on LinkedIn under Rock River Capital. It's usually or obviously feel free if when the world goes back to in-person meetings, we're at most of the big conferences in Chicago and Madison and Minneapolis and the Midwest. Feel free to stop by and chat us up.
Chris and Andy, thank you so much for your time and for being on the show this week. It was great having you.
Thanks a lot, Doris.
Thanks so much for listening. And thanks again, especially to my guests today, Andy Walker and Chris Eckstrom, the co-founders and principals of Rock River Capital. You can find more helpful information and resources on my website, globalocityservicesplural.com. There's a library there of tools, blogs, podcasts, and other resources. My door is always open for comments. I'd love to hear from you. Email me anytime at dnagel, Nagel, at lakesradio.org. Be sure to join me again next Saturday at 11 a.m. Central, noon Eastern Time. But until then, I'm Doris Nagel, wishing you happy entrepreneuring.